Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about Brookfield Corporation stock. Bruce Flatt, the CEO of Brookfield Corporation, recently participated in a live interview with Bloomberg, and he was asked a few challenging questions, and he provided interesting perspectives on the downside risk of commercial real estate market, the recent defaults on 2 office buildings in the United States, the next 12 months investment opportunities for Brookfield, the topic of share price of Brookfield Corporation, and finally, the interesting topic of share buybacks. I will include 5 short clips of Bruce Flatt's interview in this video and provide my commentary on his perspectives. I will also discuss why I remain extremely bullish on Brookfield even though the share price of Brookfield are still down almost 30% from its highs. If you look at this chart, you can clearly see that the share price always went down during the various financial difficulties and financial challenges. So this is not something new for Brookfield, for this company. For example, in 2008, Brookfield share price crashed by almost 60%. Or in pandemic, it went down almost 35%. However, this is a company with a great management team. They have a long history of navigating through various financial environments and creating extreme value for shareholders. Last month, I bought another 100 shares of Brookfield Corporation during the dip, and now I own 250 shares of this company and invested over $12,000 in this stock inside my tax-free saving account. So obviously, I really believe in this investment and this company. We have a lot to cover in this video, so let's jump right into this. The first part of this interview, Bruce Flatt was asked about Brookfield business and the core operations. Brookfield business in core is nothing other than value investing. There are a huge group of value investors who try to find undervalued assets, infrastructure, and businesses around the world, buy these assets and businesses, optimize the operations and profit margins, and then either monetize the asset or sell it for a profit and return value to shareholders. These businesses are ranging from pipelines, renewable energy facilities, and real estate to fiber optic networks, telecom towers, and even semiconductor chip production facilities and digital assets. Here is a short clip of Bruce Flatt's interview with Bloomberg, where he describes this same concept.
Bruce, so I think it's very clear where you want to be invested in terms of themes, right? We talked about infrastructure. You also focus on deglobalization. You focus on energy securities and others. Out of these themes, how do you play them?
You know, look, our playbook is pretty simple. We buy great assets in great places and invest for the long term. And those big themes of decarbonization in the world, deglobalization, just moving things back, and digitalization. Everyone's phone is receiving enormous amounts of information today, and not many people stop to think, how did I get that information? Somebody had to build the backbone, and it used to be we were building gas connections to houses, and we still do. And we were building electricity connections to office buildings. Today, we're building the backbone, the towers, the data warehouses, the fiber to the home, and all this backbone behind what comes onto your phone or your computer.
In the next part of the interview, Bruce Flatt was asked about high interest rate environment and how it will affect Brookfield businesses and their investment strategies. Here he mentioned that in sharp contrast to what analysts and market in general think about Brookfield, high interest rate environment is not bad for Brookfield businesses as they can easily find cheap deals, cheap assets, and cheap businesses and deploy their huge amount of available capital to buy these assets at undervalued prices. Here he clearly mentions that the next 12 months would be a great buying opportunity for Brookfield to buy assets and businesses, and they will go shopping soon.
We're still putting money into the market, and I'd say when capital is less freely available, it's better for us in the type of investing that we do, because the entry point where you invest is often really important. And less capital available means less people are chasing it, therefore opportunities are better.
And so you see that, do you see opportunities in the next 12 months?
Yes, yes. Look, the next 12 months are going to be an excellent investing environment. A lot of people are negative. That means it's a great environment to invest. So we're going to continue to be putting money to work in this environment.
How much money? It's riskier also.
You know, it's less risky. It always seems like it's more risky. It's actually less risky. You know, just to make the point, equities are down. Equity markets are down, which means that if you invest $1, it's over the longer term, it's less risky. Fixed income is down, meaning interest rates are higher, therefore the probability of losing money is a lot less. Bitcoin is down. Not that I'm investing in Bitcoin, but growth stocks are down.
Okay.
So everything has been has come down in the markets, and that is that means that the returns going forward will be better. Therefore, the risk is less.
Next, we arrive at the most interesting topic of the day. An interviewer asked Bruce Flatt to comment on their defaults on 2 office towers in downtown Los Angeles. His first response is that it is a tale of 2 cities, which means things are not always as they seem. I covered this topic in another video and mentioned that these loans on these buildings are non-recourse loans. Brookfield structured buildings as separate financial entities, so when they default on the debt on these buildings, creditors and banks generally can only foreclose on the building and they have no recourse against the rest of the company. I also mentioned that for a company with $800 billion assets under management and almost $125 billion capital ready to deployment, $750 million is nothing, and they could easily pay this debt if they wanted to. But this is a strategy that they chose to employ to reduce the capital loss. As a person and investor in the company, I don't like this strategy at all. I have to say this. I prefer they pay the debt, but this is a normal strategy for asset managers around the world. In fact, other asset manager businesses like KKR and Blackstone, they use the same strategy. So I guess we can't really complain about this here. But anyway, I personally don't like to see they keep defaulting on their buildings, even if that's a non-recourse loan. Here is the Bruce Flatt's response to these defaults.
Bruce, talk to me about real estate. So there were defaults on 2 loans. I don't know what that means for, how you see real estate in various parts of the world and the level of distress you're seeing in those.
Yeah, I would say that there's a real tale of 2 cities. Firstly, anything that's gone on with us, it's just regular business. This is small and not relevant to the overall business. We have a vast business and everything's financed non-recourse. Therefore, it's not really relevant to the overall business. More importantly, what's going on in the world is there's this, and it always happens, the best of the best and the worst of the worst. The best of the best today is really, really good. For example, in New York, our office buildings we're leasing, Manhattan West, for example, it's a big office complex on the west side of Manhattan. Rents are 50% higher than they were pre-COVID. We're 97% leased. We just leased one full building up of 2.25 million square feet. We did 3 million square feet of leasing last year. So the high quality space is very sought after by companies because they want to bring their people back and have new engaging space.
Well, while I agree that this will not have any major impact on other Brookfield businesses, I guess this is the only point that I disagree with Mr. Flatt here, and I still prefer them to pay down the debt instead of defaulting on the loan to maximize the profits. Anyway, next, let's move on to the next part of the interview when Bruce Flatt was asked about commercial real estate market and all this doom and gloom picture that we see in social media and news outlet about upcoming real estate market crash.
So will you see more like defaults on loans? And I guess this is COVID related.
Part of it's just a continuation of things going on before COVID just increased it. But I don't think, I'd say real estate in general, the news out there is much, much worse than the underlying fundamentals. In fact, fundamentals today are probably better, almost better than they've ever been going into a recession. Remember, when the financial crisis happened, we emptied buildings out in Canary Wharf. Like Lehman Brothers went bankrupt, one day, a whole 1 million square foot gone. Today, we're 100% leased.
So why do you see that difference between, I guess, perception and reality in your eyes? Is it inflation? Is it interest rates going higher? Don't blame the media.
You asked
Bruce.
me, I'm going to say it's the media.
No, of course it's not the media.
Finally, for the last part of his interview, Bruce Flatt was asked about the share price of Brookfield and their intention of whether or not they want to continue to buy back the shares of the company and their businesses at these valuations.
Bruce, in terms of share buybacks, I know you've been frustrated, right, with the share price level. Are you going to continue buying back shares when it's not good enough?
Yes. The answer is all company people responsible for companies should look at capital allocation. One of the great things to do is to buy what you own. And we continue to buy back shares in all of our companies when they're not properly valued in the marketplace. And
how do you define that? Is it
we
like a
just
target?
look. We know the assets all the time. And again, I'll go back to price and value. We know what the value is of our business when the price isn't achieving. When the price in the market is higher or lower, we know we should either sell here or buy there. And now we're running a business, so we can't use all our capital to do that. But on the margin, over the longer term, it's always really good for shareholders to buy back stock in the company and sink the shares. And in essence, you're buying back what you already own at a discount to the value, and that's highly positive to the owners that are left afterwards.
Overall, these were interesting points that Bruce Flatt raised during his interview. And when I was listening to this interview, I thought it could be a good idea to make a summary video based on this interview and share it with you guys. As I mentioned in the start of the video, I remain bullish on Brookfield, even after the recent downturn in the share price of the company and the extremely negative narrative about the future of Brookfield and their real estate assets. I understand the risks, but I believe Brookfield has overall a great business model with enough liquidity. They have a great management team, which is focused on value creation for shareholders, and they have lots of growth avenues by buying undervalued assets at this point in time. I hope you enjoyed the video, and if you enjoyed the video and you're interested to follow contents related to Brookfield and other Canadian companies, consider subscribing to the channel to see similar content. Always remember that the information in my videos are not financial advice for you to buy, hold, or sell any stock, and you should always do your own research before making any financial decision. Thank you for watching, and I hope to see you guys in the next video. Farewell.